Hello friends, good morning. Welcome to my YouTube channel. In this video, we are intending to introduce the final accounts, the financial statements of the business. In any trading organization, at the end of the financial period, it is always important to check and ask yourself some questions. Is the business running normally? Is the business making profits? Is the business making losses? Once you determine that, it will be very easy for the users of your accounting information to either choose to invest their monies into your business or not. Of course, every person will be willing to invest into a business that is making profits. If the business is not making profits, no one will be willing to invest in such kind of a business. So to ascertain the position of the business, whether the business is making profits or losses, organizations prepare what we call final accounts. So now, what are these final accounts? A final accounts accounts prepared at the end of every financial period to determine whether the business is making profits or losses. They would want to determine the financial position of the business. So now when we are discussing these final accounts, we are looking at three things. What are these three things? The first one is the trading account. We talk about the profit and loss accounts and also the balance sheet. So these are the three things that will constitute what we call final accounts. So to begin with, what is trading account? So the trading account is prepared to ascertain the gross profit or gross loss of the business at the end of the financial period. So what are you expected to find in the trading account? What are those items that make up the trading account? There are quite a number of things that you are expected to find in the trading account. First of all, we have the sales. These are revenues of the business. Okay, if you are buying goods and then you are reselling those goods, those are what we call sales. So the revenues generated from the sale of your items are referred to as sales revenues in the business. And these are the sales that we are talking about in here. And apart from sales, we also have the purchases. So purchases are simply goods bought for the purpose of reselling in the business. Mind you, we are only talking about those goods that we buy for the purpose of reselling. If we buy a motor vehicle, for example, as a utility vehicle in your business, that will not be classified as purchases. We are only looking at those items which are bought for the purpose of reselling. If you buy an item to be used in the business, that should not fall under purchases. Okay. Then we have opening stocks. Every financial period at the beginning, it's possible that you find some stocks which were left unsold in the previous accounting period. As we open the new financial period, we call those opening stocks. Okay. Then we also have got closing stocks. At the end of the financial period, those are goods that are left unsold at the end of the financial period. They are referred to as closing stocks. All right. It is worth noting that the same closing stocks as you begin the next financial period are the ones that we refer to as opening stocks. Okay. Then we also have got carriage inwards. Now, when we say carriage is the cost of transporting or delivering goods either from your business to the customer's business premises. You know, in business, sometimes it is very important to maintain good relations with your customers. Okay. So again, you yourself also, you are delivering goods from your suppliers, bring those goods to your business. So the cost of transporting goods from the suppliers to your business premises is what is referred to as carriage inwards. All right. Then you transporting goods from your business, taking them to your customers' business places, that is what we call carriage outwards. But it is worth noting that carriage outwards is not treated in the trading account. It's not a trading account item. That's the reason why it is missing here. So in the trading account, we will only talk about the carriage inwards, all right, which is a direct expense because it is part of the cost of buying goods that we are selling in the business. Of course, there are other direct expenses which we may tackle in the next video. But for now, we are just looking at the carriage inwards, which is a direct expense because it is directly related to the goods that we are selling in the business. Then we have got returns outwards. You know, in business, it is allowed that once you buy goods, for some reasons, you are allowed to return those goods. Some of the reasons that could necessitate the return of goods, it could be maybe you were oversupplied, all right? If you are oversupplied, it is a good business practice that you return the difference. Apart from that, you can return goods if the goods that were supplied are defective. Okay, they are defective, they are not in good condition. For example, you can be able to return those goods. Okay, if for instance the goods that have been supplied are expired, you can return those goods, or maybe they are damaged in transit, assuming the supplier is delivering those goods to your business premises. Then we have got returns inwards. Returns inwards, they are a reduction from the total sales. You know, when you sell your goods, for some reasons, like I've explained, those goods, they have been found to be defective. Maybe the goods that have been supplied are of wrong color, wrong quality, and so on. You will be you are supposed to return those goods. You cannot, of course, be selling to your customers the goods that are defective, the goods that are expired. So you will be compelled to return those goods. Those goods that have been returned to you as a business, they are what we call returns inwards. So these, there will be a negative from the total sales that we previously sought. Okay. Now, the profit and loss account is another account that form part of the final accounts. Now, the profit and loss account, unlike the trading account, is prepared to determine the net profit of the business. You know, net profit is where the gross profit, and then you subtract the operational expenses, and then what you remain with is what we call net profit. But again, it is also possible that in business you can make a loss. So when we talk about the profit and loss account, you can either calculate the net profit, but you can also find the net loss, depending on the trading, the way it has been conducted in that period. So the net profit account is made up of the following items. We have the gross profit, we have the gains, or incomes if you want, and also the operational expenses. Now, when we talk about gross profit, the simplest definition is that it is the excess of sales revenues over the cost of sales. Okay, how much did it cost you to generate those revenues? So you compare the total sales and also the cost, okay, that it costed you to generate those revenues. So that's what we call gross profit. But okay, if also in the process you discover that the cost of sales are more than the sales revenues, the situation there now will be that you have got a gross loss. Okay, but here we are specifically talking about the gross profit. Then the gains, these are incomes that you receive away from your normal trading activities. Okay, it's possible that maybe as you are trading with your suppliers, you might be given some discounts. Okay, discount received, that is a gain. Or as you are offering certain services, you can be given commission. Okay, so commission received is also a gain. So these are part of the profit and loss account. Then we also have got the operational expenses. Now, when we are talking about operational expenses, we are looking at those expenses which are not directly related to the goods that you are selling in your business. Okay, for instance, you are paying salaries to your workers, You might be, giving wages to your workers. You might be, you might want to advertise your business, and so you pay for advertisement. Those are operational expenses. They are not directly to the goods that you are selling in the business. So these are what we call operational expenses. Apart from that, you may also have a situation where you pay for insurance, okay, maybe motor vehicle insurance in your business. So you pay premiums, okay. All those are expenses which are supposed to be treated in the profit and loss account, okay. So remember, we are saying the items which are supposed to go in the profit and loss account as expenses are only those expenses which are not directly related to the goods that you are selling in the business. Very important to notice that. So these are the items that form up the profit and loss account. In the next video, we'll look at the preparation of these accounts, the trading account and the profit and loss account, before we proceed to the balance sheet. Thank you. I hope you enjoyed the video. If you enjoyed, please let me know in my comment box down this video. Thank you.